Hey guys, welcome back. This is chapter 6, and it deals with variable costing and segment reporting and how managers use these. So, when we talk about variable costing, um, we're only saying only variable costs, like direct materials, direct labor, variable overhead, are included in product costs. And then fixed overhead is treated as more of a period expense. So, the purpose really provides insight into how costs behave with changes in activity levels. So really focus on the changes of activity. Absorption costing. This includes all manufacturing costs, variable and fixed, in product cost, and it's required for external financial reporting, GAAP, IFRS, and that sort of thing. So the focus is on the total cost per unit. So you have to report with absorption and look at the total cost per unit. But the variable cost is really sort of an insight that helps you end up uh, being able to manage better by using it. So the key difference is the treatment of fixed overhead. Variable costing is fixed overhead and its expense in the period incurred, and absorption costing is fixed overhead is allocated to the units produced, and that is required by GAAP. Managerial insight, really, though, the variable costing aids the internal decision making, while absorption costing ensures compliance with reporting standards. So let's look at an example. Say production's 1,000 units and sales are 800 units. So the variable cost per unit is $10, and the fixed overhead would be 5,000, and the selling price would be $20 per unit. So if we look at absorption costing, our fixed overhead per unit would be $5,000 divided by 1,000 units, which would be $5 per unit. And the product cost would be variable cost plus fixed overhead is $10 plus $5 is $15 a unit. The cost of goods sold would be $800 times 15. That would be $12,000. And the ending inventory of 200 units would be 200 times $15 would be 3,000. The variable costing, we look at the product cost of $10 per unit, variable cost only. And we look at our cost of goods sold, which would be 800 of the units times the $10 would be 8,000. And our fixed overhead would be expensed entirely at 5,000. So we would still get to the 13,000, but it look a little different. The income statement, the absorption would be higher inventory, which increases net income, and variable would end up being the income reflects only costs that are associated with sold units. So we're very specific there and only looking at uh, what the variable costs are. So the reconciliation of variable costing with absorption costing, if we're going to take the difference in income and we're going to look at our fixed overhead allocated to our ending inventory. So if we looked at our fixed overhead per unit, which would be $5, and our ending inventory was about 200 units, the difference would be 200 times $5 would be $1,000. So absorption income would be variable income plus $1,000. But reconciling highlights how inventory levels affect income under the two methods. When we talk about some of the advantages, really the variable costing and the contribution approach really helps simplify decision making because it focuses on cost behavior and contribution margin. And it avoids misinterpretation because net income under variable costing is not influenced by inventory changes. Also, it provides clear insights. It highlights the fixed cost separately, aiding to cost control. And the contribution margin will be the revenue remaining after variable costs, uh, which really are used to cover the fixed costs and generate profit. The formula for contribution margin, it would be the sales minus variable cost, which would be 16,000 minus 8,000, which would be a contribution margin of 8,000. So you're contributing on every, if you had $100 product and you had a $70 variable cost, then every $30 that you're selling is going toward contributing to your fixed cost or even a target profit that you would set. Segmented income statements and contribution approach really report income for different segments using the contribution margin approach. So the sales would be revenue for the segment, variable expenses would be direct costs tied to the segment, contribution margin would be sales minus variable expenses, traceable fixed costs would be fixed costs directly attributable to the segment itself, segment margin would be contribution margin minus traceable fixed costs, and common fixed costs would be costs that are shared across all segments, not assigned to any segment. But the ultimate purpose would be to highlight segment performance before the common fixed costs at aiding resource allocation. So I wanted to throw some definitions at you first, but now go back and review them if you need them. But now the segmented income statements with the example. So the scenario, you're going to take two segments, the north and south, in this illustration. We're going to say north has sales of $50,000 and variable costs of $30,000. Traceable fixed costs would be $10,000. The South has $40,000 of sales. It has variable costs of $25,000, and the traceable fixed costs would be $8,000. So it'd have common fixed costs of $7,000. The calculation, if we took the North contribution margin, we took $50,000 minus $30,000, that would equal $20,000, and the segment margin would be 20 minus 10 equals 10. For the South, we would have a contribution margin of 40 minus 25 equals 15, and the segment margin would be 15 minus 8 equals 7. So the total segment margin would be 10,000 plus 7,000 would be 17,000, and the net income would be the 17,000 minus your 7,000 would give you 10,000. When we talk about segmented income statements, we take decision making and break even analysis. So the decision making helps focus on our segment margin. This indicates profitability of every segment, and it helps decide whether to reduce or expand or eliminate different segments of the business. So we want to take a break even analysis, and the formula for the break even sales for a segment would be traceable costs divided by our contribution margin ratio. So our traceable fixed costs were 10,000, and we're going to take a contribution margin of 40%. So 10,000 divided by 40%, break even sales in that segment margin would be 25,000. If we looked at our segmented income statements and we look at some common mistakes here, sometimes we assign common costs to segments, and common fixed costs should not be allocated to segments as they end up distorting segment performance. Also, we ignore our segment margins. Segment margin is critical for evaluating profitability between individual segments. Also, sometimes we focus only on total net income, which can lead to poor resource allocation. Sometimes we even overlook contribution margin, and that's what helps drive profitability and indicates the impact for volume changes. Ultimately, when we talk through variable versus absorption costing, variable costing will aid internal decisions, and absorption costing will meet the external reporting requirements. But the reconciliation between them highlights how inventory affects reported income. Also, the advantages of variable costing, it emphasizes the cost behavior and operational efficiency of the organization. And segmented income statements provides insights into individual product segment performance using the contribution margin approach. You really want to avoid some mistakes, which by properly differentiating traceable and common costs to make informed decisions. That's sort of a highlight video between variable and absorption costing. You'll get more information on that as the week goes along. Check all the lectures, check everything we have. And if you have questions, let me know. You guys are doing great. Just let me know if you need anything from me. Take care.